the great financial crisis, ramped up to 80, COVID-19, 83, and I remember that. That's the COVID candle of doom when everything was going to shit. Markets were hitting circuit breakers left and right. They're pausing trading. It was just pure pandemonium. But really, we hit 50, which like has not been seen since those two events. That's a pretty huge, like historic spike. But he writes on his blog that everybody should be cool. Why? Because 94% of all stock market years since 1928 have seen a drawdown of 5% or more. So let that sink in. Like that would be like saying in crypto, every year since crypto started, we've seen at least 20-25% pullbacks in Bitcoin, probably 50% in altcoins, and that happens every single year. That's just how this goes. So 94% of years have had a drawdown of 5% or more. 64%, like half, basically over half of all years, have had a 10% drawdown in stocks, which of course correlates to like a 40% drop in crypto. Although the data suggests we're living through the norm, it won't change investors' amnesia. People love to freak out every time the market drops. And it says that it's not just CEOs, but or not investors. CEOs are now mentioning the Federal Reserve at record levels in their earnings calls. So like it's something that everyone's concerned about with rates now, being the highest they've been in quite a long time. And the mention of the Fed on earnings calls has hit a record high since this has been tracked since the year 2000. So interest rates obviously matter for stock performance. Higher rates have pushed our national debt instrument payments into absurd levels. The interest expense on U.S. public debt rose to a record of $1.1 trillion over the last 12 months, more than doubling over the past 2 years. At current pace, it will soon be the largest line item in the federal budget, surpassing Social Security.